Greetings, everyone. This is Cathie Wood, founder and CIO of ARK Invest. And it is Employment Friday once again, but the government is shut down, so no employment numbers today. Nonetheless, we will have in the series of charts a number of perspectives around employment to share with you. So as usual, we'll go through fiscal policy, monetary policy, economic indicators, market indicators, and weaving in innovation ideas throughout. Before starting with the charts, though, what I'd like to do is summarize our position. I know the markets are extremely nervous right now. The equity market and the crypto markets especially. And we think we understand why, and we also think this too will pass because there are some very short-term reasons, mostly having to do with liquidity drying up, again, very short-term, associated with Treasury and Fed balance sheet, or the Treasury general account and the Fed balance sheet primarily. And so we'll go into that in a minute. But we think that they will clear up within the next month. We have, first of all, quantitative tightening ending on, I believe it's December 1st. Now, many observers expected the Fed to end quantitative tightening with its last meeting. It did not. That was a little unsettling to the markets. And we're hearing from various Fed officials that there is more fear that inflation will not continue to unwind. We have a very strong view to the contrary. But the burden of proof is on us. The indicators have been sticky. Tariffs are one of the reasons, even though business has absorbed, we think, at least half of the shock from tariffs. So quantitative tightening, we think, will end December 1st. That's a de facto easing. And then the various liquidity tightening moves have to do with the Fed reducing its reserves. We're now down to 6.6 trillion. And at the peak, I think we were close to 9 trillion. The Treasury general account is at 940 billion. Normal over the last 3 years has been 600 billion. So the Treasury, because the government is shut down, is building cash and not releasing it into the system. The Fed has been very concerned about all of the easing and inflationary ramifications coming out of COVID, and they still are there, although they have been easing. Interest rates have been coming down since late last year, haltingly to be sure, but they are coming down. By some measures, and we'll go through the charts, while the Fed is easing, it is still quite restrictive. And so we need to hit that tipping point. And we do think that the next Fed meeting, which I believe is December 10th, will be the next decision, that the Fed will take interest rates down again. Now, I am a little concerned that we seem to have more hawks now building on the Fed. That's a bit of a change. We think that the labor market conditions are going to get worse, especially because at the end of September, I think the federal government let go 150,000 people, if I'm not mistaken. So they will get worse when they are reported. And I think that's going to change the dynamic considerably. So when will they be reported? Well, we need to get the government back to work. And the odds are, or the prediction markets suggest, that that will be around November 17th. I did just see that Senator Thune is calling everyone back to work over the weekend on a continuing resolution. So it could be a little sooner than November 17th. But then the funds will be flowing again. So again, this is short term. I don't like what we're hearing from the Fed because I do think that they are missing some deflationary signals out there. And we'll get into a few of those. So let's go through the charts, and we'll start, as always, with the budget deficit, since that has been top of mind. A record-breaking deficit during COVID. It is coming back. You can see we're at 5.7%, which is better. We were not too long ago, almost 8%, so getting better. And I do think there are a couple of things going on. The government shutdown has been accompanied by a reduction in force recently. So again, I think DOGE is having an effect and an ongoing effect. And then on top of that, we have a more broad-based reduction in force. We know one of the pressure points, we've heard that Secretary Duffy has said that we're going to be canceling 10% of all flights. That's a little bit more pressure on the government to get this thing going. And then I'm going to show you a chart on SNAP. That's the Supplemental Nutritional Assistance Program. We'll get to that in a moment to give you a sense of really how out of control spending was, and in some senses still is. And yet this is a political football, as always. This used to be called food stamps, I think. Before going there, I do want to reinforce that we think after this short-term period of discomfort, and it is uncomfortable, believe me, I know, that the rolling recession we've seen in the last few years will turn into a rolling recovery, and we're getting some green shoots already. Employment lag, so the unemployment rate probably will continue moving up, even as this rolling recovery gets underway. And then we think next year, we will be in much more of a productivity-driven, almost boom in economic activity, mostly because of this chart. And I know I've presented it, but for those of you who haven't seen it, I wanted to make sure everybody has seen this, everyone interested in the know. And this came out of the tax package in the One Big Beautiful Bill, OB3, July 4th. And what you see here, manufacturing structures, this has never happened before, full depreciation, 100% in the first year of service. Normally, depreciation takes place over 30 to 40 years. This is turbocharging the concept of accelerated depreciation, and companies putting manufacturing structures in service within the next 3+ years. They just have to be started by the end of 28. Will be able to depreciate fully in year one, which means they're probably going to get a big tax refund. And then you've got equipment, domestic R&D, and software. So I would say that's very innovation oriented. Those will be depreciated in their first year of service completely. And that change has been made permanent. So it's been legislated. That has never happened before. So these are very pro-growth, pro-business policies. And we think they're going to attract a lot of foreign direct investment into the United States. Effectively, you can see the corporate tax rate. So the effective corporate tax rate is going down to roughly 10%. Statutory will still stay at 21%, but effective, thanks to these depreciation measures, will go down to 10. Now, that's one of the lowest in the developed world, if not the lowest, lower than Ireland's roughly 12 or 12.5%, which is very interesting. Again, a call for innovation in the United States. Now, here is that SNAP participation rate that I referenced versus the unemployment rate. So you can see after 08-09, that crisis, the SNAP participation rate went up from roughly 10 to, let me see, I have to get this down here. Yes, 10 to 15%. And it's only gone down to 12.5%. And despite the fact that the unemployment rate is really near a record low. So there's something wrong with this picture. I looked up the poverty rates as I was looking at this chart saying, well, wait a minute, hasn't the poverty rate in the United States gone down? And yes, the poverty rate recently peaked in 2010 at 15% and is now down to 10.6%. And so, and that I think is the lowest since 2003. And you can see where the SNAP participation rate was in 2003. It was around 7.5%. So even here, there is overspending given what is given the macro backdrop in the United States. And so, you know, the president and the administration hanging tough on cutting back some of these spending programs because they are probably being abused to some extent. So just wanted to feature that given the debate that is taking place out there. Okay, now flipping to monetary policy. Here you can see money growth in the purple line. So 4.8% as of September, the latest reading. And you can see the inflation rate kind of stuck now in the 2.5% to 3% range again. So let's look at these in the context of history. The purple line, you can see money growth is at the lower end of normal for all of these years, going back into the 60s, including the disinflationary years, which really started in 1980. So 4.8%. And you can see inflation, 2.5 to 3, is at least relative to the disinflationary years at the higher end of the green line there. Now, so the Fed is worried that it's stuck. And I think tariffs are complicating the picture. If we are right, we are moving into a highly deflationary age. And a lot of that is good deflation associated with technology. I know I've talked about the huge deflationary ramifications of robotics, energy storage, and especially AI. And those are playing out, we believe. But we have the tariffs, and we also have the lag in housing price measures. I think also oil is breaking down. It's below $60 on West Texas Intermediate. So we do have a lot of forces pressing down, and they've been obfuscated, we think, by lags in the data and by tariffs. But all of that is going to pass. We think next year it will become clear. And believe me, I know that I've been saying the risk is on the downside of inflation or deflation. And yet we've had these extenuating circumstances, and maybe I should have anticipated some of the lags. Nonetheless, I do think the bond market is beginning to understand that we're going to see inflation resolve to the downside, not remain stuck or even go up. Now, trueflation is that measure that we talk about a lot, which is, I think it's thousands, maybe tens of thousands of items measured in real time by this organization, Trueflation. The latest reading here is 2.5%. So again, kind of stuck where it's been for the last couple of years. We do think, again, tariffs have been an important part of the recent tick up, and that the worst of them will roll through, and then we'll be on the other side of that distortion, that real distortion. And yet we don't think that it's going to encourage huge buying, because people are continued huge purchasing because people are worried about further price increases. In fact, we can see from the Consumer Confidence Index, which came out today, that the intentions to buy are not picking up very much at all. That's what the Fed would be worried about, that there's sort of this anticipatory purchasing, which drives prices even higher. We don't think that's going to happen. On the next couple of pages, well, on this page, actually, there's quite a bit of drama here. And I'm going to give Julian, who used to work at ARK, but is now working for one of our clients. He sent us this chart, and it is provocative. This is the ratio of the gold market cap to M2 and expressed in percentages. And what this is saying, given the rapid increase in the gold price during the past few years that we've seen, we wanted to assess, well, what does this metric look like relative to history? And what you can see here is two prior peaks near this level. One was in the Great Depression. And what happened is this peaked, I believe, in 32 or 33, and then it started moving down. We went through a reprieve in the Depression. Many people think it lasted throughout the 30s. It was at its worst in the early part of the 30s, or its most intense. And then in 1932, I think to 36, if I'm not mistaken, we had a reprieve, and then a relapse in 37. During that reprieve, what we saw was money supply going back up. It had been declining, and the gold price was fixed back then. So all of this move was a function of money first declining. There was a deflationary bust, and the Fed wasn't picking up on it. And the Fed was fairly new, or they wanted to make sure not to let inflation out of the bag. And so they tightened way too much. Money collapsed, GDP went negative, pricing went negative. And you see here the gold price to money went up to its highest level ever. And then they started easing. And the stock market had one amazing move after that happened, with the smallest stocks, the lower cap of the spectrum, having absolutely spectacular moves. So that's the first time this hit its peak, and then when it started down, we had a huge burst in the stock market. The second time we hit a peak here was in the aftermath, or it was the rise was taking place throughout the 70s, early 70s, 71. We closed the gold window, and you can see what happened. There was a flight to safety, a hedging against inflation that took place throughout the 70s and peaked in 80, 81 with inflation and interest rates, actually. And then after that, we had the golden era for actually both stocks and bonds. We went through a long period of disinflation, but especially the 80s and 90s were they were golden for the financial market. Sure, we had our corrections here and there, but the financial markets did very well during that period. So here we are again, and I do think it's interesting and instructive. When did this bottom? It bottomed in the late 90s, early 2000s, when the Fed eased for three reasons. First was long-term capital in 98. Long-term capital threatened really a financial collapse. And the Fed came in for that reason. It came in 99 because of Y2K, the fear that the globe was going to shut down because the computers had been written for the 1900s and they left off 19. And we were entering a new millennium that would have to switch over to 20. And the Fed was fearful, and a lot of other people were fearful that the global economy would just shut down. So it eased for that reason. And then the tech and telecom bust. It eased for that reason. And I think as we're examining more about this period in history, that essentially led to an inflationary period that took oil prices in would have been 2008 to $147. We just broke below 60 on that basis. So it was a period of inflation. And then this latest period, I think, was set off by certainly the Russian invasion of Ukraine. And we saw a lot of sanctions and confiscation of Russian wealth. And I do think that's one reason the gold price got going. And then all of the other geopolitical risks out there, including still Russia and Ukraine, the Middle East, and China, especially under this administration, effectively declaring a sort of war there, economic war, technology war, if you will. And so there has been that flight. Now, I want to go to the next chart, which takes apart the gold market cap from M2. Here you see it. And just to hearken back to the 70s, you can see, because they had been holding the gold price flat, the gold price, the gold market cap is the gold in the yellow there. And the purple is the money supply. So money supply was well ahead of gold back then. And, part of what happened in the 70s with gold, when we closed the gold window and allowed ownership of gold again, I think that was in 1974, we had, a massive move towards hedging against this inflation with gold. And it pretty much ended when the gold price or market cap crossed M2. And here again, that period, we had that quiescent period during the 80s and 90s for gold, but money supply was going ahead, but the velocity of money peaked in 97. And so it didn't, the money, that velocity rolling over diffused the inflationary ramifications of a rise in the money supply. And you can see what happened as we moved into the 2000s. After those three easing moves by the Fed, the gold price took off again, and pretty much stopped when it hit M2. Well, here we are again. And in fact, we've gone beyond it, much like we did in 81. So I wouldn't be surprised if we are peaking gold relative to M2 now. And as I mentioned, these other two times when we peaked and resolved to the downside were really good times for the financial markets. So just wanted to share that with you and thank Julian for sending this chart over, because it did stir a lot of conversation and debate and lent a lot of perspective to the questions we have today. Now, here we have Dan Rodriguez at ARK working on some economic research and has worked in the fixed income markets for many years. And you can see here, this is inflation expectations, effectively, is what this chart is, as measured in the bond market. And you can see they've started to come down, but they had been going up this time. And this is probably one of, for the last couple of years, one of the reasons the Fed is a bit cautious. And you can see what happened after COVID. Well, during COVID, there was fear of deflation, but then the supply shock and the inflation ramifications we saw in this metric. Well, the inflation expectations have been cut in half since then, but recently they were rising. And I'm sure the Fed is looking at this as, a warning. So good to see that it has resolved, or it's starting to resolve on the low side of expectations here. Here is overnight liquidity. Now, this is what I referenced, and Dan Rodriguez has provided us with this chart. And I should say Will Share, who heads up our trading as well. And what you can see here is a tightening in liquidity. Now, I look back pre-COVID and I think, well, why won't we be going back to that level of liquidity? You can see in 2017, 18, and 19, again, those were the Trump years. We were doing just that. We were lowering the liquidity. Now, in 2018, that was a big up year for the stock market. 2017, sorry. 2018 and 19, those were weaker years for all kinds of financial assets. So when liquidity dries up, yes, financial markets struggle. And I think that's partly what's going on right now. And as I mentioned at the outset, we think that the Fed will continue to ease, the government will reopen, and so the Treasury General account will release funds as well. And the only thing really that I'm wondering, and we'll get into it in a moment, is what will happen to the velocity of money. It has flattened out. And on a year-over-year basis, it is just ticking down. It's going negative. So if money growth is up 4.8% on a year-over-year basis, and the velocity of money starts falling now, then that will represent a disinflationary or a deflationary impact on the economy. Now, here is another indicator suggesting the Fed is restrictive, too restrictive, should continue to ease. And that's one part of the yield curve, shorter end, measuring the 2-year Treasury yield against the 3-month Treasury yields. And you can see here, when this metric has been negative, it has typically, not always, but typically been right before a recession. We escaped in the mid-90s and in 1998 when the Fed responded to long-term capital. But pretty much every other time we've ended up in a recession. I do believe that when the statistics are revised and measured more correctly, including, incorporating new technologies, that this period, maybe others will start calling it a rolling recession as well, if not an outright recession when all the numbers are revised. but it is still negative, inverted. This is still inverted, and typically that is associated with weak economic activity. This is the yield curve. It's measured by the 10-year versus the 2-year, so the a longer time frame. And I've been struck since 08-09 that this has been in a downtrend, even throwing as much monetary and fiscal stimulus at the economy in COVID as possible. Couldn't get it beyond 150 basis points. Never got it into that 200 to 300 basis point range. And on this basis, it seems as though it's beginning to top out here. We shall see. We shall see. This is very short term. And what that will tell me or confirm in my mind is that the bond market, at least, is seeing this deflationary undercurrent that I'm talking about. And long rates are not going up as much as they normally would, because the bond market is incorporating some of these deflationary undercurrents. Now, here's the velocity of money in green. And, for years, I was trying to figure out, why did the velocity of money, after rising for so many years, why did it peak out? And the only metric that resembles this at all is the labor force participation rate. And you can see the labor force participation rate is starting to fall again, and the velocity of money is rolling over. Now, if it actually starts falling, then what that means is to keep the economy growing at a 5% rate, the Fed will have to ease more. Money growth will have to accelerate. So we shall see. But why would the labor force participation rate continue to move down? Well, a few things. We're having, baby boomers are beginning to drop out. I think and so that some will remain in the labor force, but we are getting 1.3 million retiring per year. The ones staying in the labor force, well, as we're moving into the AI age, may not have the skills they need. Although, let me just tell you, anyone can develop these skills. Just start vibe coding, learn all about it, and I think the sense of agency that will bring about, this can do, I can create new businesses. That's true of any age, and especially younger people who are natively AI. So it doesn't have to be that technology is going to displace a lot of people. There is short-term displacement, but the opportunity on the other side of this is huge. So I want to encourage everyone there. But if the labor force participation rate is going down because of skill set mismatch and so forth, the velocity of money will probably continue to roll over, because that's uncertainty in people's lives. So I think that's something the Fed really needs to recognize. Here's real GDP versus productivity. The X there is an estimate for where we are. So it has held up, and I do think it's because of productivity and new technologies, which means if these new technologies are infiltrating the global economy as much as we are seeing, then productivity will continue to go up. What that means is that real GDP growth can accelerate thanks to productivity, and inflation can come down. Because productivity, essentially, all other things equal, lowers unit labor costs. Now, maybe companies will pay people for being more productive, and they should, and they probably will, but they'll also use it to reinvest and so forth. So just wanted to present that. So where are we now? Manufacturing and non-manufacturing. Kind of stabilizing, manufacturing still contracting, interestingly, services ticking up very recently into positive territory. So that's a green shoot. Services prices paid is another reason the Fed is probably holding back. They don't like this chart. This is at the higher end of of the range, in the last 25 to 30 years. Not good. New orders are picking up in the green there. I thought as new orders picked up, pricing would come down, but that is not happening. So the Fed is probably on guard here, and we're probably going to have to do a little more digging on what in the services space is rising in price and how much is impacted by tariffs. Here is just getting into employment a bit. The green line here is the payroll employment number in millions. And you can see in the tech and telecom bust how much payroll employment fell. You can see also corporate profits. They bottomed well before employment turned up. It's another way of saying this is a lagging indicator, employment is, and companies really try and turbocharge productivity as they're coming out of recession. So this was the 01 to 03 recovery. This is 08, 09, same thing here. The profits bottomed at the end of 08, and employment really didn't bottom until 2010. So lagging indicator, wanted to reemphasize that. Also came across this chart. This is from the Fed, and it's the labor shortage index. And you can see massive labor shortages are associated often with wars. You can see World War I, World War II, the Korean War, Vietnam, and so forth. We are today, from a labor shortage index point of view, where we were in many of those wars, except for World War II. Now, I think part of this is because of survey work, and we believe there's been labor hoarding because there was so much, there were so many problems getting labor during COVID. So I think this is going to continue falling. But that is interesting perspective because, I think companies held on to workers, and you're starting to see the Challenger layoff survey. I think it was the latest month was up 175% in reduction in force announcements. So they're starting, and I think it's because this labor shortage concept and hoarding concept is disappearing. Here's another labor indicator. It's the jobs easy to get minus jobs hard to get. So you can see coming out of COVID, jobs were easy to get. Now they're getting harder. As this goes down, the jobs harder to get are increasing relative to those easy to get. And you can also see that this indicator declines before and during recessions. So again, this idea of rolling recession is shown clearly in this chart. Here is the unemployment rate of recent graduates. So that's in the purple line versus the overall unemployment rate. And you can see recent graduates, the increase there in the unemployment rate is steeper than in the overall rate. And that's because entry-level jobs are giving way to AI. But here's where I want to really encourage young people. Go for it. Go for it. We're in such an early stage of AI. Learn to vibe code, use Replit, use ChatGPT, and basically say you want to start your own business, and how should you go about that, and start figuring out what you've always wanted to do in life, and go for it. Especially if you're out there looking for a job, keep doing that, but also release some of that psychological pressure by taking control of the situation and going for it with AI. Very early days there, and we think the wave is enormous going forward. Here you can see the quits rate. Whenever it's going down, people they're getting more and more uncomfortable with the job scene out there. And you can see that usually happens during a recession. So here we are, another indicator saying rolling recession. Duration of unemployment, this is moving up, and we don't even have the latest numbers yet. But this, the Fed will start responding to, we think. And as it becomes more and more obvious that this is not going down, people cannot find jobs. It's taking longer. Here is another, you can see the Chat GPT moment with the dashed vertical line there. And the number and job openings. Well, a couple of things are going on. They shot up during COVID, way above trend, way above the uptrend that has been in place since 2010. And then we had the Chat GPT moment, and we have normalization after COVID. So two things going on. We're a little bit below trend now, the uptrend that would have been in place. But you can see here also the S&P 500. The S&P 500 is responding to some of the productivity gains that ChatGPT and other AI tools have unleashed. So that's pretty interesting. Here's, you can see the personal saving rate in terms of, are consumers pulling back? Are they moving? Is the saving rate going up because they're cautious about the future? That was true for a little while, not recently, and it could be that the people who are getting hurt by what's going on out there, they can't save. They're not making enough money to save. Here are home buying intentions. They'd love to buy a home. Here's University of Michigan saying, what are buying conditions like? Terrible time to buy. That's a survey. Here, pending home sales, ticking up recently, a little green shoot, great, but wow, very low by historical standards. Here's new and existing home sales. Again, very low by historical standards. I remember in the late 70s, we were at this level, and the population is so much bigger now than it was back then. Here's new one-family houses for sale. So, the builders have been speccing, and now they have an inventory, and they're either going to have to cut prices. Recently, they have been buying down mortgages to try and get home sales moving, and they're stirring a bit, but they're going to have to do a lot more, or interest rates will have to come down a lot. Here are prices. Okay, so new home prices have been falling for a while, but not enough, clearly, because they're not clearing the inventory from that builders have. You can see existing home in the green line, existing home prices, those increases are continuing to slow. They're moving towards zero as well. So let's see what happens in the next few months there. Loan delinquencies, another measure of consumer pain out there, which again, I'm sure is one of the reasons velocity is rolling over, but the saving rate is not going up. Delinquency rate, so subprimes in purple, all is in green. We're really reaching levels seen in 0809 for both. And I think one of the reasons is we now have Uber and Lyft. Maybe people who are experiencing or suffering in the current economic environment are just saying, I'll let them take my car. I don't care. I can pay as I go with Uber and Lyft, and soon autonomous. Here, flipping into capital spending is non-defense capital goods, new orders for them. And we think this has just begun. We think we're at the beginning of a big cycle here in the United States, thanks to tax policies, foreign direct investment, and so forth. So we think, if you look at this, it used to peak out at the same level over the last, 25, 30 years. And we've burst through that. We had a little bit of a test. And now we're out the other side. And of course, AI and power are driving this, but we think it's going to spread. Here you can see the trade deficit. It's building again, and this is something we predicted. If our economy, which in real terms is growing faster than other economies, if that is true, and actually if we accelerate relative to other countries the way we think we would, the deficit could continue to increase as we import more and export less purely because of the differential. Dollar is not crashing. It has been on the weak side recently, but it's not crashing, which is the narrative out there. Here you can see the S&P again. This is earnings per share. So you saw straight up earnings per share are up. And we do think the ChatGPT moment, 22, was a very important moment. You can see earnings were starting to tip, and then all of a sudden they turned right back around. Here's the commodity index. So are we in an inflationary world? The commodity index would say no. You can see we peaked in 2008, and that was because of the 3 easing rounds in the late 90s, early 2000s. We're well down from that, and we are where we were in the early 80s, early 90s, and so forth. Here you can see some of the indicators we've been showing you for years now. Metals to gold ratio still falling. What is going on? I think it's China, and we saw that exports to China, exports to the United States from China were down 25%, I think, in September. They were up 3% to the rest of the world. What does that mean? They're probably cutting prices more aggressively in order to get increased uptake in the rest of the world, given what's happening in the US. That's a deflationary impulse, all right. And you can see the green line here is Treasury yields. Why aren't they as highly correlated today as they have been? The high correlation stopped in 22 when the Fed started tightening. Well, maybe if the Fed eases, this will come down more rapidly. And we think it will. And we think the inversion of the yield curve might continue for that reason. Copper, so the idea of, okay, metals to gold, that has broken down completely. Is it only because of gold? Look, copper is increasing in price, just not as much as gold. That could be, but there's another reason. Copper is behaving differently from many other metals in anything electric vehicles and so forth. Data centers, lots of copper. So this could be a relative price shift for copper and not the economic indicator that it has been historically, and would suggest that that's broken down because manufacturing has been negative, contracting in the US for 3 years now. Here, for market-based indicators, S&P to gold, this one we've been watching like a hawk, gold up, S&P wobbly. So you see testing. We do think it's going to resolve to the upside ultimately, especially if the chart I showed you earlier with gold price going down relative to money supply, if that is what happens now. The odds are high that it will happen because, as we saw from that chart, there are only 2 other times it's been this high. So we do not think it's going to resolve like the 70s when S&P fell relative to gold dramatically because inflation was such a problem. We think quite the opposite, deflation is. And here's an example of that. Price of the S&P relative to oil. The oil price is going down. That's a massive tax cut. That's good. And we think this will be a leading indicator of the S&P to gold. Here is the Treasury yield over, well, we saw the golden age. We had 40 years of declining long-term rates on balance, and that has changed. We didn't want them to continue going down. The quantitative easing and 0% interest rates basically suggested that the market was not working. We want the markets to work. We don't want the Fed to manipulate markets. And so the Fed is not manipulating anymore in terms of, certainly not in terms of easing. It may be too tight, and that might be what this chart is saying. We shall see. Here are spreads, not a care in the world. This is high yield spreads, so high yield rates relative to 10-year treasuries, and not a care in the world. And, I find that very interesting. And I think it's partly because where are the excesses in the markets? They're not on the equity side of the equation. They are on private credit side and maybe private equity side, but certainly private credit, that search for yield. I think that we're seeing that here. And we've seen First Brands and a number of blowups out there, still not affecting this. Maybe it did for a moment in time. But we think that there has been a lot of ill-advised lending out there in the search for yield, and that this will move up as more of these, I'll say, blow-ups occur. And then finally, Bitcoin. Now, I was on CNBC, and the only part of the clip that I think taken out of my appearance was where I said that the biggest surprise to us over the last, since we started our research on Bitcoin into actually 2012, is that stablecoins are starting to usurp a role that we thought Bitcoin would play. We thought Bitcoin would be an insurance policy for emerging markets against confiscation of wealth, either outright or through inflation and other terrible policies. What has happened is the stablecoins are taking over. They've hit almost $300 billion. And so we think that that insurance policy role will take $200,000 to $300,000 out of our bull price. But that was in an all other things equal world. What has also happened, of course, is what we've been discussing. The gold price has doubled. So the gold market cap has doubled. And part of our analysis for the potential for Bitcoin was that maybe it would become half the market cap of gold. It would take some share from gold or maybe expand the market. Well, that market has doubled. So I don't think our bull price should change all that much. And I probably should have been quicker to say all things equal on CNBC the other day. So I just wanted to clarify that. We are very bullish on crypto assets, but we know that they are the most susceptible to liquidity drawdowns. And I described earlier, we have a number of reasons for liquidity drawdowns now, but we think that they will be cleared by the end of the year. And hopefully by December 10th, when the Fed eases. And hopefully when government statistics come back and we get the employment report in early December, which is the next time that I will have the pleasure of doing In the Know. So hopefully we're in the clear by then, and the bull market that we believe is firmly in place will continue apace. So thank you very much.